Hello and welcome back. I am Robert, and I am here to show you a problem that traders often experience: when to know how to take profits, or more specifically, how much profit should you take. Now, we are using this particular chart as a reference point for the strategy that I'm going to be talking about. This is a support and resistance pullback. The source code is available on my Patreon. The link will be in the description. So if you're interested in following this kind of a strategy, please be sure to sign up. From the standpoint of this technique, I'm using a very specific market structure called a cyclical market. And I've analyzed 2.1 million candles. That technique has let me test and retest an interesting pattern for the purposes of what this technique is being used for. I'm using it for either grid trading or micro aggressive strategies, where each position is really only 2 cents of value. Of course, never do this with a real account. Always practice with a demo account first. But the interesting part of this technique is that it has a minimal risk and the outcome is quite interesting. So let's get into that. Okay, as we have on the screen, we see that I have 4 different profit windows, from 10 pips to 40 pips for the Euro USD. Every one of these are profitable. This particular technique, using a micro strategy or a micro aggressive strategy with multiple positions, is designed to get in and out of the market as quick as possible for a large number of positions. So the first strategy, 10 pip take profit, it made 5,002 sells. It made a profit of total of $6. And this is running from 2020 to October of 2025. So again, not a lot of risk involved if you did use a real money account, though I don't recommend it. What we have is a maximum number of 83 open simultaneous positions. So at the worst point of this strategy, 83 positions were open at once. At 2 cents a position, that's not a lot of risk. Roughly $1.60, $1.70. But still something to be aware of when you're trying to evaluate your trading. At the end of the simulation, I had 19 open positions. Those would have become losses if I just sold out everything and walked away from the account. That's not bad. That's respectable. So as we look at the 10 pip strategy, $6 if I just walk away taking my losses of 19 open positions. That's a pretty good amount. That's good risk. But let's look at the 20 pip. The 20 pip made nearly double, $5 more. The number of trades didn't change much, but the maximum exposure did. 151 maximum trades, or roughly $3 maximum exposure versus the previous $1.60. Again, that's not bad, and there's nothing wrong with that, to be honest. The maximum of 29 positions, or roughly 60 cents if I walked away from the table. So $11.70 I would have cleared. Not bad, acceptable, comfortable. Now, we keep going though. 30 pips, $17 profit. That's very good. Not much in terms of the selling points, but the maximum positions has gone up again, and so has the open positions. So I'm sure you can see the pattern here, even as we look at the 40 pip take profit, $22 in profits. $22 for a 2-cent position size is wonderful. 4,855 total sales, a maximum of 274 open positions. That's starting to get a little high. Even if your account can handle 1,000, still, one position being this saturated could be a problem depending upon what the market does. Unless you're using a micro scalping strategy like what I'm discussing. And even then, 274, 300, $6 at risk, roughly speaking. And of course, 80 open positions. That's going to be a loss of roughly $1.60. That's still $20 and some change you're going to walk away from the table. All 4 of these techniques are profitable. And that's the problem that a lot of traders run into when they actually look at their back tests or their market research. All 4 of these will work great. So how do you pick which one is best? How do you pick which take profit will give you the best result? Well, the greediest trader will pick the highest, and they will take on the highest risk no matter what the consequences. The problem with that is they often don't have the risk management necessary for the kind of risk they take on. A more cautious trader will take the lowest. They'll walk away happy, they'll get a profit, and they won't worry about it. The cautious trader is probably the smartest one out of all of us, simply seeing the opportunities here as minimal risk. A more seasoned trader will take a look at their own risk assessment and pick something that better fits their own strategy approach, their edge. And the edge isn't the indicators. It isn't the trading philosophy of MACD, RSI, Bollinger's grid bot. None of that matters. The edge is the trader's ability to manage the risk they take on. That is the true secret of trading. The true secret isn't the indicators. There are 1 million people using the same indicators every single day of the week, and 90% of them, if not more, lose money. The true edge is your ability to manage the risks of the technique you are using. Every technique on the market can be profitable if and only if you understand your risks and you manage those risks appropriately. That is the biggest challenge of trading. Not which strategy to use, but how you maintain your risk in that strategy. You could even take the strategy of flipping a coin and make money on it, if and only if you plan your risks. I've talked about this countless times in the past, and it really is the ultimate. It is the deciding factor above everything. Whether you use a simple technique or you use something like what I've built, which is a support and resistance pullback strategy. None of that matters if you can't control your risks. If you can't decide how to actually keep your risks under check, you're going to get your account liquidated. It is far better to settle for the lowest possible profit than to get greedy and blow your whole account up if you can't manage your risks. Because at least the person that settled for the lowest profit level, he walked away with money in his pocket. He accomplished what the greedy person did not. He didn't blow his account up. As you think about who you are as a person, that will be your biggest hurdle in trading. Not the market, not big institutions out trying to wipe you out by placing strategic orders that cause liquidations, but your own inability or ability to manage your risks will be your worst enemy. Everyone takes losses in the market. There's no way around that. That's an absolute. Every single person takes losses, no matter who they are. What matters is how you manage those losses, your risk assessment, your risk management. You could take a simple account that trades micro pips and actually do very well with it. You could take $1 million account and turn it to dust by not paying attention to very simple details. That really is the whole point of this entire discussion. When you're looking to make money in the market, don't think about the strategy as much as your own ability to understand it and control it. That is what will decide whether or not you walk away with money or you lose your money. Share your thoughts. Let me know what you think about your trading techniques. How do you measure risk in your own trading? Let me know. Leave a comment below. If you know somebody struggling with their risks, share this video with them. Maybe it will help them. Thank you for watching.